So we're going to start with clicking on your icon that you have, and that will open up the program for you. You'll see your splash page with the logo on it, and then you would open up a new file. So if we click on New, and we see that it starts off with our common and agreements screen, but perhaps to make things a little bit easier, we're going to name who the supporter and the recipient are as our first job. So be careful when you're putting the names in that the supporter is the individual who is paying the other person. In this case, we're going to put in Dick as the person who's the supporter. He's age 55. And you would put in whatever street he lived on, the city, and you click on the province that you wish, their postal code, and then of course important is to put in the province for the taxes. If we scroll down and look at what else there's left to put in, you may or may not need to enter in here at all. If Dick were going back to school, then you would enter in this supporter education information. If he's not going back to school, then you would leave it blank. If he were going, then you would put in what year that was going to start, so 1, 2, 3, 4, to how many years he was going to be there, and then whatever the dollar amount that he would be able to use as his tuition deduction. The other personal deductions would only be used if there were special extra deductions that you would find from that TD1 form on the CRA website, or we provided for you in your manual. The regular personal deduction is already calculated in the program, and if Dick has a child living with him, the fact that you're already going to let them know that he's living with him, the program's factoring that in. This would be used if Dick had a disability and could use the disability tax credit, or was a caregiver, or one of those unique times. So we'll go up and we'll save this right away. So we'll do our save as, and then we will be able to just hit save going forward. So now you'll notice it's changed from supporter to Dick. If we go over to recipient and we're putting in Jane, who is 53 years old, and wherever she's living, her province, postal code, and for sure the province for her taxes. Now once again, in this case Jane is not going to school, so we would leave this blank, and her personal deductions are already going to be calculated in there because Jane doesn't have any of these unique situations. So then we can just hit save and go back to our agreement tab, so that we then put in the things that are the same for both people. You're going to enter in here the amount of years that you want to project, and then you can put in the children at this point. And so we have the 2 children, and you'd put in their name, and in this particular case, Barry is 16, planning to start school for post-secondary at 18, staying there till age 22. And if we keep going over, the full tuition credit of $5,000 could be claimed, and normally it would be by the higher income earner, or it could be split. 1 year somebody would use it and 1 year somebody else would use it. And then we put in the other child, who's age 19, started school at 18 and will still be there until age 22. And again, $5,000 because of our situation, we'll put the supporter. And then if we keep going down, This is, just so I'll go this up a little bit. Because you're doing the claiming of the children, it would show here who is going to claim them. And in this case, because they were going to be living with Dick, who is the supporter, you would click on supporter, and for another couple of years. And if we look at, and you would save that and then move on to the agreement tab. So with the agreement tab, we are going to deal with support. Due to this being a long-term marriage, we'll leave it at $99, and Dick, even though he didn't want to pay, Jane's lawyer says he's going to pay $102,000, and it would be linked to his 3% salary. Because he's going to retire, the income that he would have wouldn't be enough to pay that much support. So in year 6, it would change, and if we look over here in year 6, it's grown, and so that's why as a result we do $102,000 as a negative, and you'll notice then it brings it to around $16,000 of support. We enter in the information saying that it changes due to Dick retiring. And then if we go down to the child support, if he were keeping both children, then he wouldn't be paying any, but if they were sharing, there would be. So for another 7 years, child support of $18,000 based on the guidelines, and again the increase of 3%. And if we look over here, we see the $18,000 increasing. There'd be an adjustment when George leaves in 4 years, so it would be a minus $12,000 for his expenses, and we'd put in our comment that George leaves home. I've just created a new way to spell George. And there you see that it changes once again. So we'd go once again, go up and save. And then we're ready to move on to the information that's specifically to each of the people. So we're going to go and click on Dick. We already did this part, so we would start using these other tabs. So in the income section, we'll just move over our screen so that we can see what we're doing. And being as he does not have a defined contribution pension, we would not click on this has employment with pension. We would strictly go down here and enter his employment income. And he's going to keep working and retire at 60, so we put in year 6. $350,000 is what his base income is, a 3% increase. And he also has that self-employed income, and so there he's going to have that $60,000 of income, but that's not indexed. And then of course we have the rental income, which we're not sure if and when it's ending, so we would just enter rental income, $24,000 for his portion, 4% increase. And then again, we would save that. If we wanted to look and see what it showed, we can pull this over a little bit and we see the various types of income showing for him. Then we would go on to his expenses. And just so we can see all the fields, we'll move that over again. So his current household expenses, we can put our little note in there, and he is saying they're $40,000 and a 2% increase. For another 2 years, he's going to be doing his RESP contributions, so $2,500 there, but we don't have to increase that by any indexing. And then ending in year 4 when George leaves, these expenses that he's had for George that are specific to him will end, but we would keep those indexed. And then in year 7, Barry's expenses and again we would index. And then if we look, we can see his regular 40,000, the RESP contributions, expenses for George, expenses for Barry. And if we went all the way over, we see the total for his costs that then reduce when the children are gone. And once again, you're going to hit save. Go on to the savings tab. And in this situation, we know that we've got half of the joint account we're going to put in because no one's decided what is being divided quite yet. And it's a 1.3% return that they're getting. He's got an RSP of $545,000, and he's got room of $59,000 if he wants to contribute more. His expected rate of return is 5%. He's retiring at age 60 and then expecting to get a little bit lower rate of return. His TFSA is worth $34,000 and he's got $5,500 of room, and it's been doing very well at 6%. So once again, we're going to save and then move on to his debt worksheet. And we have the line of credit for $45,000. Oops, maybe we'll make it too high. And that's at a 4.5% interest rate. He's doing $500 for his portion. And then his car loan is $30,000 at 1.9%, and he's paying $600 a month. And if we look over here, we can see the various payments going down over the time frame. Once again, we're going to save and go on to the real estate tab. So here we have the matrimonial home, half of the value at $327,500, and if we move this over a little bit, we can put in our annual increase, etc. But there wouldn't be any capital gains because of it being the matrimonial home. Then we have the rental property. So his portion is $250,000, and his portion of the mortgage is $150,000. $1,000 monthly payment on his part, being as they're splitting everything, 4% interest rate, 3% of the annual increase. This would have a capital gains, and we know that his portion of the capital gains would be, $25,000. And then his office property, he's going to sell in year 6 when he retires, and that's $750,000 with a $400,000 mortgage, paying $3,000 a month on that, and it's a 5.5% interest rate, also growing at 3%. Also would be a capital gains, which is $125,000. And once again, if we want to look at this, we can see the various different properties, the mortgages going down, and the sale and capital gains of the office building. So we can once again save and move on to the investments. And they had a market value, oops, $25,000. And that is increasing at 3%. So we'll just go and save that. And if we wanted to look, we can see the 25,000 increasing in value. Now, if we want to see what all of this looks like, we would go to the base cash flow. And we can see the graph for Dick. We wouldn't be able to see Jane's yet because we haven't entered her information, but if we move that over, we can see all of his data that we've already entered. So this is his income while he's working, and then his income once he's retired. This is old age security kicking in at 65. His minimum withdrawal from RSPs, that's that real estate that he sold. His taxes, his expenses, his mortgages, loan payments, that child support, the spousal support, and his net cash flow, which is positive while he's working and then goes negative, and where we would have to, do something to see how that would be able to change. If we click on the adjusted cash flow, we can also see this pretty much same information, just in a little bit different format. And this allows us to do some other things. So it shows the outgoing, it shows the cash net flow. I'll just move this over so we can look at everything. We aren't seeing any of these extra contributions or that, which we need to put in, because we know that he is doing some. And so that's, I just want to show you all of this, but then we'd pull this back a bit and we would utilize that. So we know he's doing RSP contributions. And we would enter those in. So basically the 1 to 6 is what we would do. We know that he's doing a fixed amount. You do have the option of maximizing, adding a percentage of his surplus income, etc. But basically he is doing a fixed amount. So we would enter in that he's doing that $12,000 a year and apply that. And then you see it pop up. And you could do that in his TFSA as well. So if we then chose the TFSA contribution, again, and if we said we were just doing it while he was working and he was maximizing, you would hit apply, and then you would see those pieces come in. Just as you've done that, we can, do some other things. Now, as far as doing withdrawals and that sort of stuff. So we could turn around, and what we'll do first is we'll take this cash and we'll invest it. So we could turn around and we can put in that we're going to do a contribution of $590,000 if we wanted. And that would take it out of that amount of money that he put in. Whoops, I guess I should have put that in the other space. Take this one out, and then we know that it absorbs that money. That would allow us to then go where these negatives start into his savings adjustment, and then change that to being year 7, and I'll just put in 10 for now, and cover the deficit. If we hit apply, it's going to absorb some of that money that we had in savings, and you can reduce that deficit accordingly. So If we go on to the net worth page, then you can see what happens, and this sort of shows you the RSP while he's working, and then it flipping to a RIF when he's not. Shows you the tax-free going up. It shows you the TFSA balance and the saving balance with that other money going in there. His investment balance, real estate, the mortgage, the loans being paid off, and his net worth. So we're pretty much done with Dick at that particular point, and it just depend on what you wanted to do as to how much more you would go back and adjust things with the adjusted cash flow, because we certainly could also adjust with the TFSA withdrawal to help cover the deficit, and then as you notice it goes to zero, etc. So we can go on to Jane and see what's going to happen with Jane. So again, we go to her income. Now in her case, she had a LIRA from a previous job, so we would click this open so that we could enter some information there. And you could enter that it was, former hoop. Because she's not working there, we wouldn't put anything in the current pay or an increase. We would show the balance of what it was worth today. 28,000. And then we would go down to the rate of return. We wouldn't worry about the retirement age because it's not a normal pension, it's just a LIRA for her. And we would put in that she's going to start drawing at 60, the rate of return while it's growing, and then she feels it's going to get smaller so that she would have the 4% increase there. Now, right now she is working for another couple of years, so we put in employment for 2 more years, and 31,000 what she's earning, with an increase of 1.5%. And she's also getting her portion of the rental income, that 24,000, at 4%. She's going to, though, start her pension in that time frame of quitting work in 2 years. And so you click on pension, she's going to get 15,600, and that's indexed at 2%. And so again, if you want, you can go over and you can see her employment income, the defined benefit paying out, her rental income, etc. And actually, we forgot to do this for Dick, so we'll have to go back and do it. She's going to apply for her Canada pension at age 60. And based on her situation, she's getting 62% only. And again, we would save. And you'll notice that that did also populate her CPP starting at age 60. So if we go to Jane's expenses, in her case, she has new lifestyle expenses or household expenses because of leaving the matrimonial home. And that's 38,000 at a 2% increase. She also is helping pay something for the boys. So when George finishes school, after 4 years, she will not have to pay the $3,500. And in 7 years, when Barry finishes school, the $3,500 she's paying for him won't be there any longer. However, after that, she's going to start traveling. And so in year 8, we put travel begins, and her $5,000, which she's allotted and isn't going to put as an increase. And once again, you can see all these for the boys, and then $5,000 starting for her. So you would hit the save button and go on to her savings. So half of the savings, the joint savings, was $7,500 at 1.3%. That's what they were earning. Jane's RSP is worth $130,000. She has $40,000 of RSP room and is earning 5.5%. She's planning to start the RIF at 55, and it will earn 4.5 then. She also has a TFSA worth $15,000, so $21,000 of room, and it's only earning 3%. And once again, we would save and move on to Jane's debts. So her portion of the line of credit gets entered at the $45,000. 4.5% was the cost, and her portion was $500 a month. And again, you see it populating here. And you want to be careful when you're doing this that if you put in $6,000, you're going to have an astronomical number for the payments, because it's a monthly payment. It's showing you over here an annual cost. So she has a Visa bill of $8,500. That's 19% interest. Well, she wished it were 0.19. And she's paying $200 a month. So then again, we're seeing that right there. So we hit save once again and move on to the real estate workbook for her. So the matrimonial home, once again, her portion is the $3,275. No mortgage, but it is getting that annual increase of 2%. $250,000 for the rental property, with $150,000 for her portion of the mortgage. She's also paying the $1,000 a month on that. 4% is their interest rate. It's growing at 3%. It definitely has the capital gains of $25,000 for her portion embedded in it. And so if we want to look at that, and for we recommend you actually get the large screens so that then you can kind of see everything and you don't have to do this, because we're doing a high resolution for you to see everything, but on a large screen you can see the whole thing. Here's the value of the property, the mortgage, her payments. So again, we're going to hit save and go to investments. Her investment portion is that $25,000 for her half of it, and an annual increase. And so once again, you're going to save. If we go to her base cash flow, and if we want now, we can pull in Dick's, and then we see both people's. Keeping in mind we would have to enter Dick's pension for CPP. And so then you can see, and if you want to check out the taxes, you can click on the separate tax button. So here's her income. That's when CPP starts. If we scroll down here, we can see OAS income. If there's any clawback, her minimum withdrawal. If we keep going over here, we see the spousal support, child support. And when we do the separate taxes, we can see the federal and provincial taxes, her expenses, the mortgage, her payments, and her cash flow, which is fairly positive while she's getting the support at the higher income. A little bit of negative in here. If we go to her adjusted cash flow, because we haven't put in her contributions either, and we'll just click that so we can see it. And so in her case, she's doing a fixed amount as well. And so her fixed amount is $2,400. Should should really only be for 2 years. And so then we do that. If we want her to do the maximizing her TFSA, which she says she's going to do, could be through her whole time, we hit maximize and apply, and it will maximize wherever there's a possibility. And if we keep going over here and we see the negative, we could go down here and choose savings, or in this case maybe we'll use TFSA, whoops, withdrawals, and this would be year 5, I believe, 6 actually. And that if we want to cover that deficit, we would hit apply, and then money would come out of here to make this go to 0. If we want to then look at their net worth, you click on that. Again, you see Jane's by herself. This shows you the lira that she had, and then it turning into a LIF, her RSP, and then turning into a RIF, the TFSA, her savings, if they split those 50-50, the investments, real estate, mortgage, her loans, and her net worth. And then if we want to compare the two in the graph, we would show the two of them. And that's pretty much all you need to do. Anything that you want to see, if you like whatever's there, if you go to print, not report preview, but print, it's going to show you a preview, a report preview of whatever you wish for every page. So this gives us a snapshot that you can print, and you would print each page individually and not just hit a button for everything to print. You'll pick what you want. If we go back to Jane and look at her adjusted cash flow and hit print, we're going to see exactly what we had already seen there. So it shows you all of those figures. It shows you taking out of things. And if we went to any of these other pages, if we went to debts, for example, and hit the print for the print preview, it's going to show us the line of credit, the Visa, it shows the payments, and when she'd be debt free, and that sort of thing. And once again, we're going to go, seeing as we're going to go back to the agreement tab, and then from there onto the common tab to look after planning work that you may be required to do with equalization. So after you've entered everything, maybe later on they figure out how the equalization is going to work. You have the option of having it paid to either the recipient or the supporter. In this case, he owes, so it's going to be paid to the recipient. For the one part, he's going to pay $25,000 a year for 5 years while he's working. And if we go ahead and save that and go to see how that plays out into things, if we look at the base cash flow, we'll see an equalization payment being paid by him of $25,000. So it shows a negative, shows his cash flow is still okay. If we look at Jane and her base cash flow, we see equalization and $25,000 coming into her and giving her an even better net cash flow while those dollars are coming in. Now, as I said, Dick was going to do that. It provides no tax deduction for him though, and it gives no tax that she has to pay on income because it is the equalization payment. And what he is going to have to do though is, because he owes this $250 and he's going to pay part of it over the 5 years that she's agreed to, we're going to have a loan that starts out, and you can just put in, whoops, that it's equalization, my goodness, keyboard's gone crazy on me, loan for $125,000, and a 4% cost, with him paying $2,000 a month so that he can get it down as quickly as possible. And so there we would see this new loan, which he'd go into retirement with a bit, but it wouldn't be too bad. And again, if we go look at his cash flow, it does cause him a bit of problems now. So we'd have to look and see whether that's really doable to do that $25,000 over the next 5 years, or whether he should do a bigger loan. But this allows you, if we go back to that, to make that adjustment for equalization and see what would happen. And then you've pretty much done everything that you would need to do for this particular case, and you would just print off all the pages that you felt were important and do your written report, and you're done.